Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, a couple there, risk and general. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase in decrease in importance over time. The central theme at the moment is certainly one that is very relevant for this week. It's of course central banks and really their greater resolve to fight inflation, whilst also increasingly being willing to sacrifice growth to get there. This, of course, has supported the dollar, the US dollar, and really also that currency, the greenback, maintains a safe haven bid as well. And we've seen that especially this morning with the ramping up of geopolitical tensions in Ukraine. As I said, certainly this week is packed with central banks with this focus on raising rates, policy tightening, and obviously the effect on certain currencies. The dollar has made new highs for the cycle. We'll be looking at that in depth. But generally, just for this webinar, for the next 3/4 of an hour or so, we'll check how markets are setting up going into a potentially really volatile 48 hours for the next few tonight and tomorrow. Obviously, we'll then run through some technicals on some of the major stock markets in the US and also the German DAX. We'll then review actually US CPI from last week briefly. Big implications on that shock red hot inflation report, and also then check out gold. Actually, we haven't done that for a while, but gold obviously impacted by those inflation figures, by a rising dollar, and worth checking out the technicals. On bullion, we'll then of course preview the Fed, the FOMC meeting tonight, and also then we have the BOJ meeting overnight and then the Bank of England meeting tomorrow. So all worth highlighting the key points around those central bank meetings, also then the associated majors. Firstly, it's worth looking at how markets are set up going into some of these meetings. As I've said, the dollar is strong and has made new highs for the move, but really we're in a kind of risk off mode this morning. Actually, markets really bracing themselves for this flurry of central bank meetings, and also then we've had Russia potentially mobilizing more troops in Ukraine, and obviously there being a flight to safety. We actually make it around 8 central bank meetings over the next 48 hours, including, of course, those G10 major ones that we've mentioned. The S&P as well, we should say, is making a decision tomorrow, along with the BOJ and Bank of England, as we said. All eyes certainly on Fed Chair Powell and the FOMC. And really it's around the terminal rate, with investors considering a 75 basis point hike tonight, pretty much a done deal. Some, of course, are still calling for an even larger hike. We'll dive into that shortly. Just a point on this terminal rate, hopefully many of you have heard of that and heard many people on television reading about this terminal rate. Essentially, just to reiterate, that's the end point for rate hikes. So the point where the Fed funds rate will peak. And it's not to be confused with the neutral rate. So that's the rate at which growth and inflation over the medium term really are in equilibrium. So basically the neutral rate is neither restrictive or stimulatory. And that rate is kind of consistent with full employment and capacity utilization plus stable prices. As I've said, there's been much talk about this, about the terminal rate, but also then rates going into restrictive territory, and that's to slow down growth with then hopes of a soft landing. But the Fed certainly at the moment looks less likely to achieve that goal of a soft landing, really, as it's been sounding quite aggressive hawkishly, which means its rate hikes, its policy moves could push an already slowing economy with many leading indicators already starting to decelerate. It pushes then the economy into recession, and this is obviously the fears around stocks, around risky assets. This morning, of course, risk off generally. Asian stocks declined with the broad MSCI falling. European markets, actually, they've now sort of flat on the day, really. Quite interesting. A big sell-off on the overnight moves down in Wall Street, but now DAX, looking at the DAX, is just back to flat actually now. So quite a big pairing of losses there. Really, this gloomy, subdued sentiment really comes after last week's major world indices, if you like. The MSCI Broad Index of developed and emerging markets, that dropped actually as a kind of a barometer for global risk. That shed 4% actually last week, its biggest fall since June. And in general, it's concerns, as I've said, about the health of the economy and the spectre, if you like, of further big rate rises from these major central banks, which are really spooking investors. And there's kind of no sense that much really that sentiment is turning for the better. Certainly gas prices, which have been a driver of the euro, of markets in the Eurozone, they've tipped lower as markets anticipated kind of lower demand this winter due to the slowing economy, but there also have been better than feared gas stockpiles, really. But the question now is, in the near term, do we get anything positive from central banks about when possibly the hiking cycle will peak? We're probably not that near to it now, but any hints of that would certainly please risk assets. FX wise, today and this week, we mentioned the dollar DXY chart here. That's risen to the highest level since 2002, corresponding to the DXY. Obviously, the euro makes up the vast weighting of that index. That's now flirting with post 2020 lows. As we've said, Putin moving to mobilize troops in Ukraine. So really hitting the single currency. It's down 0.42% on the day. And then also we've had a move in sterling. Sterling against the dollar, obviously the dollar strengthening, sterling softening. That's fallen to new post 1985 lows now in the face really of the new UK government's fiscal response to higher energy bills and rampant inflation. So just looking at risk assets firstly, I'll just pull up the S&P chart actually, which you can see this daily. Normally like to go to the weekly, just ignore that short-term fib if you can. I think just touching on the Fed and what happens over sort of Fed announcements, I think studies show that US stocks generally they rise on the day when a Fed hike is announced or has been announced this year. This is probably due to positioning, and markets really have quite high hawkish expectations, and the bar is probably too high. It's kind of a buy the rumor, sell the fact kind of price action. The S&P 500, for what it's worth, that's climbed roughly 1.4% on all of those days on the Fed hiking. There were gains of more than 2% on 3 of the 4 days this year. And further out, the benchmark index, that S&P 500, that's gained on average more than 1% on Fed days over the last 10 meetings. That said, after the Fed, so tomorrow essentially, it's worth noting that these gains really mostly are given up. Yes, certainly. So there's a sell-off a day later. So if we look at the technicals on the S&P, this is the weekly, and you can see really what's interesting to us is this big red candle here. That is called a bearish engulfing candle. So before that, you can see a darker up candle, then followed by a large red candle and that really engulfs literally the smaller green candle. So you've got a bigger range, a wider range engulfing that smaller up candle. And this is classically signaling lower prices to come. And you can see on this weekly chart then we broke actually through trend line support actually from the mid-June low, and broken that at the end of last week. In fact, you can see here that trend line really supporting prices a couple of times, and then we've broken lower actually after the CPI move. You can see the big red candle, that CPI move there, and then we broke lower on the Friday. So a close lower into the end of the week, also quite bearish. This is the daily actually, so you can see really prices near term anyway. We sort of bounced off 3,900. That tallied with the 61.8 fib level of this summer rally, if you like. So we bounced off that fib level 3,900, and also then that trend line support, or that trend line actually upward trend line acted as support. But we couldn't really make much headway above the these two lines, the light blue line, a 50-day moving average, and then the grey line, the 100-day moving average, around 4,000. We poked up there for a couple of days, but then that US CPI figure really hammered that rally, took back really all of those gains, 4 days worth of gains really. US CPI sharply lower. In fact, it was the worst day, I think, on the S&P in 27 months, and the S&P hadn't actually fallen as much as 4% since June 2020. So yes, we've fallen below that trend line support, actually now acts as resistance, below 3,900 as well. We look to get up there on Monday. The start of the week looked better, but again we've fallen yesterday, and we're approaching actually a bigger fib level. If I just pull out to the weekly, a bigger fib level, which is the 38.2 level, 38.15, that being from the pandemic low up to the all-time high there. So we have that sort of longer term level at 38.15 as support potentially, and then this shorter term fib level around 37.84. Those are levels of support below. Before then we probably get to that mid-July low at 37.21, and then approaching sort of 3,700 and below. Resistance, as we said, this trend line above 3,900, and then those SMAs, the simple moving averages, the 100-day moving average just above 4,000. So that's the S&P. The NASDAQ we think we should look at as well. Again, you can see on the weekly a bearish engulfing candle there. Just pointing out, obviously, that rally we did, we've got this descending bear channel here, long-term descending bear channel. We sort of poked out of that for a couple of weeks at the start of August, middle of August, but then the summer rally sort of faded around the 100-week moving average, 13,720 really, and then we've sort of dropped back into this descending bear channel. Then more recently, that bearish engulfing candle really pointed to lower prices potentially. Support, major support is therefore at the mid-June low at just above 11,000, and then you have the 200-week moving average actually at 11,161. On the daily, we can see really support, near-term support is Monday's low at 11,710. Before then we get to these levels sort of in June, probably the most significant around just above 11,300 potentially, if we get this bearish momentum continuing. Interestingly, that big move after CPI actually was something we don't see really, or we only see actually in times of real market stress. I think at one point, generally across the NYSE, nearly all 2,000 stocks fell in value in tandem. And as I say, that's really only seen at really severe, really in periods of severe market stress. I think not one of the Nasdaq's 102 members closed in the green after that CPI data. And that's the first time that's occurred since the pandemic market crash, actually over 2 years ago. So that is the Nasdaq. Just for the Dow, we should look at that again. Similarly, a bearish engulfing candle last week, pointing to lower prices. You've got the 200-week moving average there at 29,757. If we go to the daily, again, bearish momentum really. And if we take out yesterday's low at 30,465, then we're probably getting to the mid-July low at 30,143. That's next support. Before then, the mid-June lows are below 30,000, 29,653. Potential targets for Dow bears then. I think it's also worth looking at the DAX. That's the index of the 30 biggest companies in Germany, of course. And really now we're nearing, again, key long-term supports here. You can see support levels, the March low at 12,438 there. And then the June low, actually, sorry, just to recap, the March lows at 12,382. And then we have these lows sort of in July, June around 12,383. If we pull then to the daily, you can see strong level of support there. We tried breaking it a couple of times or touching near to it a couple of times in July. Then we had obviously the summer rally, but now sadly we're sort of closing in on major support around 12,300, 12,400 or so on the DAX. Okay, we'll quickly do a recap actually that we mentioned of that US CPI data. You can see how important it was, what the market reaction was really for what happened after that shock, red hot data. Really, that was obviously the key risk event everybody focused on. Really, the market actually focused on, but particularly preparing for downside surprises actually. And what we got, as you can see from the graphic, I'm sure you're aware, obviously the headline rose 8.3% annually, 0.1% it rose on the month, and really consensus was for a drop to 8.1%, and on the month actually a decline of 0.1%. Instead we got the opposite really, and also on core inflation, really important, stripping out the volatile food and energy costs, that rose to 6.3%, estimated was a drop below 6% to 5.9%, and then the monthly rising again substantially 0.6% really from the analyst estimate, and the July reading of 0.3%. So you know, shock, red hot inflation really. It was hoped for, as I said, that there would be downside surprises, and all in all really the report probably implies a higher destination point, if you like, for the Fed funds rate, for the policy rate in the US, and really signaling as well increased conviction in the need to keep rates higher for longer basically. And really then once that destination is reached, really we're moving into a sort of restrictive zone we touched upon earlier, but for a longer time to bring back inflation down to the Fed's target, if you remember, which is 2%. Market reaction, we've shown you the stock market reaction, big sell-off really, and that was because the terminal rate that moved up to 4 to 4.25% from sort of 3 3/4 to 4% range before the release. Really, it's the Fed's not tapping on the brakes at all and really having to slow demand quite quickly with front loading of rates to get it inflation really back to its target. This period actually sort of reminding many actually around what happened in the early 80s with the Fed head at the time, Paul Volcker, really trying to suppress inflation. Then he took rates to 15% and was really prepared to accept sort of a recession as collateral damage, if you like. Of course, no one in the market thinks Fed funds policy rate is going above 10% anytime soon, but really it's this inflation release which has opened up the terminal rate moving above 4%. As we said initially, the reaction was to push it above 4% into that range, 4 to 4.25. But then we'll touch upon Fed funds, the terminal rate now looking around 4.5%. And just touching really on US CPI, we can see then, as we said, hopes for it peaking, but remaining sticky, remaining persistent and elevated. You can see here this long-term chart and how much further or higher than the sort of long-term averages here, and sort of staying around that. The orange line is obviously the core CPI, which obviously moved higher, even though the headline did, of course, move lower on lower gasoline prices, of course. And then we've just got a couple of other charts really showing these underlying core measures really increasing to new highs. We've got different measures of the core here, and they're really around when we strip out some of the stickier elements of some of the elements in the core reaction, really. The sticky prices, if you like, that is actually the Atlanta Fed's measure, which tracks sort of goods and services whose prices can't be changed, can't be easily changed. But it's just showing you really this sort of protracted rise, protracted and elevated, how elevated prices are at the moment. Really important really to understand this, because this is obviously a key driver for central banks at the moment. We said we would look at gold, so let me just pull up that chart actually for gold. Just bear with me 1 second, which is here. You can see the daily gold chart really. But it's a CPI again affecting commodities like gold, and obviously then the rising dollar. We could see the move lower is actually the CPI move on the 13th of September sort of broke down from this sort of bearish consolidation, if you like. We were sort of tracking sideways, but then the move lower really heralded a few days of selling in bullion. We dipped to 2-year lows actually on last Friday, and that's really driven, as I said, by the CPI reports pushing US Treasury yields higher, and also then the dollar really on expectations of these more aggressive US rate rises. The key downside level is, of course, the August 2021 spike low at 1677. We've marked that on here as key support. That is reinforced actually by the pandemic bottom at 1676. And then the July low at 1680. So a big sort of zone of support, potentially resistance. Prices on Friday, they briefly dropped to 1654. That's actually 19% below the recent peak in March and 8% lower than its price at the start of the year. And it's interesting. We should a big reason why we're touching on gold actually is gold generally traditionally has been viewed as a hedge against long-term inflation, but that has obviously not been the case this year. And gold is tracking real yields, which are above 1% now. And real yields, just to clarify, those are yields adjusted for inflation. So they're projected inflation minus the nominal yield. And they've been in negative territory since sort of March 2020 until April this year, where they finally moved into positive territory. And now, as I say, they're above actually 1% now, and that's a real driver for gold prices. Remember that higher rates make non-interest bearing assets like gold less appealing, and that's because in effect they raise the opportunity cost of holding non-yielding bullion. So where are we technically? As I said, we can highlight that support resistance zone around 1676, 1677. We did create that, hit that new low at 1654 on Friday, but we're just tracking sideways, really waiting for this Fed announcement. If we just go to the weekly, you can see this sort of bearish channel, if you like, and that key resistance, key support level at the moment highlighted there. You've also got the 200-week moving average, that black line around 1676 as well. So a massive juncture really for gold, whether we break down, get a strong weekly close below this sort of zone, and then potentially we're looking at levels around, well, the next level 1670, and then below that potentially if we do break that key support level. Otherwise we push back up sort of probably towards 1700 or so, 1720, and then the 50-day moving average at 1733, but sort of back into that sort of sideways trading potentially. Okay, let's get to the main event of this week. Of course, that is the Fed meeting, which is of course released later today. I just want to pull up sort of market positioning. This is actually only done last week, but you can just see how this Fed funds rate has moved higher. The light blue line was last week's actually, but just trying to highlight where we were a few weeks ago, and then just this protracted move higher, markets positioning for higher interest rates from the Fed. The key question really is, firstly, how big the Fed rate hike will be. There are, of course, lots of speculation around it being this bigger 100 basis point move. I'm just pulling up the CME Fed watch tool for you. Yes, so really you can see chances are of a 75 basis point hike. That's given an 84% chance by Fed funds futures. You can see the meeting today, and really a big 100 basis point move is really now only given a 16% chance. A 75 basis point move, that would be the third straight rise of this size, taking rates to the 3 to 3.25 target range. That would be the fifth hike this year. But really, yeah, speculation around this 100 basis point move, the hike of the century, one investment bank called it actually. But we think we haven't had any signal from that Wall Street journalist who revealed a larger than expected 75 basis point hike in June. Obviously, we're in a Fed blackout period, so there was some speculation we could get something from that journalist. We haven't had anything really, and really you kind of think the Fed won't want to surprise us now. Of course, that shock, sort of hot and sticky CPI report meant that the 1% move, that hike, was a potential risk. And if we just scroll down here, we can see, well, we were given around a 25% chance of that happening a week ago. I think it moved above 30% after the CPI report, but now we're back to sort of half that now, around 16%. Really, you kind of think that a move of that size, it would really unnerve Wall Street, denote potentially some panic in Fed ranks, and then also raise the prospect of the Fed potentially tightening policy too much, and then that would reduce the chances of a soft landing. The other key question then, aside from the initial rate hike, will be around the updated Fed projections, the summary of economic projections, and also the dot plots. So this is where Fed officials offer their individual projections for where they see interest rates, that's on the dot plot, and then where they see inflation, unemployment and GDP over the course of the next few years. And we'll actually get projections out to 2024 and 2025. These projections, they were last released actually in June, so some time ago really, where the median forecast for interest rates, that lay at 3.4% by year end, and then 3.8% by the end of sort of 2023. But at present, well, futures markets, they expect rates to be 4.2%, 4.25%, that is, by year end, and then to peak in March of next year around, as I said, 4.5%. So it's kind of revisions to how these forecasts, what the revisions are, which is obviously critical for markets going forward. The economic forecasts, they should show really some signs of a worsening economic outlook. So growth forecast being cut, inflation forecast rising. But it's kind of a notion of broad resilience really in the US economy should kind of be the baseline scenario. That's what's expected by consensus really. So then its key is how high is the revision in the median dot plot, with consensus really expecting that to be, as I've said, in the sort of 4.25%, even 4.5%, some people looking for that area for 2023. If we do get that period, so if we get this period of the Fed holding the Fed funds rate steady at an above neutral rate, that terminal rate closer to 4.5%, then that's kind of the bare minimum that markets are looking for. So a 75 basis point hike, hawkish language, plus relatively hawkish projections is the bare minimum really, and that's probably why we pushed up, why the dollar's pushed up, of course, and why stocks have sort of slowly taken a turn for the worse. Anything less than that is going to be perceived as very dovish really, and you'd probably see the dollar sell off quite strongly initially, at least, because potentially we're getting an earlier end to tightening with a lower terminal rate. If, of course, we get that 100 basis point hike, potentially, it is, you know, a non-negligible chance of that at 16%, then you'd certainly get a knee-jerk stronger dollar, higher terminal rates really, especially inflation forecasts being revised higher, that would push the terminal rate up, and obviously then we'd potentially look at 5%. I know some people are mentioning that, but that would obviously be seen as hawkish, price data staying sticky, obviously, and the market's then second guessing the meaning of restrictive as well. All to look forward to. We just note, we should highlight some sort of dollar positioning going into the Fed CFTC data. So that's data released weekly on a Friday, the commitment of traders report that measures basically the net long and short positions in futures markets taken by speculative traders and commercial traders. It's kind of a great resource to gauge how heavily these market players are positioned. And at the moment, from last Friday, it shows traders clearly long the dollar, 5 straight weeks of net buying, and we're actually now at the most stretch since July 2020. Let's just look at, it's probably worth looking at euro dollar actually. First of all, the world's obviously most popular currency pair, the most traded currency pair. It actually held up quite well, or better than some of its G10 peers. This is euro dollar daily here. You can see the chart. Short-term charts kind of reflecting demand on dips really, just before today, in fact. So again, we've got a zone around 99.50, 99.60. You can see here we've put in that line, the dotted trend line there, or dotted support line really, and we're oscillating above and below there. So really acting as a sort of zone of support and potentially resistance. But then obviously today we've had this sell-off below there. We've actually pulled off from the lows, the low at 98.84, and we're back to sort of above 99 now. So huge sort of area of support resistance. The actual September low is 98.63 there, so another level of support. But all sort of determined by the Fed. We don't have much out of the Eurozone this week. We've had Lagarde being slightly more hawkish, really, talking about a higher terminal rate potentially. But yes, around 99, just below parity, key support / potential resistance if we do break lower. Above, yes, 99 sort of 52 area, then we have the 50-day moving average, which kind of capped this sort of push higher above parity. We had highs capped around 102, and then this long-term trend line here, you can see that also capped levels, which sort of is moving down towards parity. So that's euro dollar. And the potential really or significant zones of support resistance as we head into the FOMC meeting later this evening. The other meetings we probably should mention, the Bank of England meeting firstly. We've got the cable chart here, so sterling against the dollar, but just talking about the Bank of England, the pendulum in markets anyway probably favors a 75 basis point rate hike. That's obviously how the Fed have gone down that path, the ECB have gone down that path as well. It's a pretty close call really. But the hawks will be worried about this recent slide in sterling. Markets, as I say, probably preferring us edging towards a 75 basis point move, but probably consensus among analysts really is for another 50 basis point move. Likely that's after a similar size move in August. If you remember, that was really breaking the mold for the Bank of England, who normally only go by 25 basis point moves. They went by 50 in August. The minimum is 50 now. At tomorrow's meeting, and then markets generally thinking another similar type move, size move, 50 basis points in November as well. The MPC, they've raised rates the past 6 consecutive meetings. As I say, August saw the first 50 basis point move. So interesting sort of whether we get a 50 or even a bigger 75 basis point move. Should highlight as well, Friday sees a mini budget by the government. That's due to provide details on government's energy plans. Recent reports really show the new government really pushing for tax cuts as well, including possibly a stamp duty on home purchases. So that may sort of, all these measures may ease kind of some concerns about the economic outlook in the UK, but then it does fuel these doubts about the sustainability of this expansionary fiscal policy. While the government delivers this massive energy bill of support, the packages now for households and then businesses potentially costing around £300 billion over the next 2 years. So really that's seen this issue with sterling and with gilt yields really, and potentially for external investors really pulling money out of the UK, out of gilts. I should probably touch on, well, the data, last week's data actually showed really this continued tight labour market, also consistent wage growth as well. That sort of adds to this mix for the Bank of England with this looser fiscal policy. The hawks will, as I say, be worried potentially about the fall in sterling. They'll worry about as well workers' shortages, potentially leading to core inflation staying higher for longer. That all kind of means more MPC tightening over time, as I've said. Rates further out from tomorrow's meeting expected to be above 1.75%. Sorry, they are 1.75% now, expected to be at least 3% by year end, and near actually now 4.5% as an end rate next year. For sterling, well, sadly, it hasn't helped sterling, and I think we saw that reaction, actually a comparable reaction, if you like, from the Swedish krona, who hiked by a surprise 1% actually yesterday. Expected was 75, but the krona took a note, sold off really after that surprise rate hike even, and sterling's kind of suffering from that same mentality. It's a pro-cyclical currency as well, but the negative growth environment really is impacting on the pound, turning it against the dollar, also against the euro. We'll have a look at that chart briefly. It seems really, as I've said, the UK bond market is starting to prove uneasy with this fiscal outlook, and that's really trumping this tightening by the Bank of England. Cable, well, long-term trends, you can see that bearish channel. We should probably extend that now, because that really is, let's tighten it up actually a touch. Long-term bear channel, as you can see, and prices really dropping below 114.09. If we just drop to the weekly here, you can see that pandemic low at 114.09 there, and we drop below that on the weekly. Again, you can see a bearish engulfing candle actually there from last week, engulfing that up candle briefly, and then on the daily, you can see we're just dropping now below sort of 114.09. Intraday low, I think today 113.04. Many sort of citing 110 as a target, and some even citing sort of no real support until the early 1985 low at 105.20. Yes, very bearish outlook for sterling. If we just look at euro sterling, because that's popped up above previous resistance, now support really around 87.21. You can see that's June high around there. We've broken above that and then tested it a couple of times actually in the last couple of days, but pushed or remain above it. So potentially that is now support 87.21 in euro sterling, but much will depend of course on the Bank of England. Finally, let's look at the Bank of Japan meeting. That's overnight really. I've pulled up the dollar yen chart there. Bank of Japan really expected to maintain its ultra loose monetary policy. Market participants really focusing on whether authorities will directly intervene to stem the yen's descent really to this multi-year high in dollar yen, multi-year low in the yen. The policy meeting, well, it follows quite a tense week last week. If you were following it, Bank of Japan officials phoned up currency traders inquiring about market conditions in a so-called rate check, really getting lots of people excited, not seen sort of since the 1990s really, but illustrating the government's sense of alarm around the yen's sharp fall against the dollar. Because in the past, as I've said, such checks have really preceded intervention by the Ministry of Finance to control the exchange rate. But regarding the meeting, well, pressure on the yen unlikely to affect monetary policy. Kuroda, the governor, Kuroda really has repeatedly argued that it needs to maintain its stance, its policy stance, its uber dovish stance, if you like, until wages and inflation rise in a stable and consistent manner. So really, most economists expect Kuroda to stay the course until his term expires in April, actually next year. And if you think about it, the Bank of Japan is kind of stuck between a rock and a hard place, really, because it's defending its yield curve control. That is where it caps 10-year Japanese government bonds at 0.25%. amid muted inflation, really, but then it obviously faces pressures from the Ministry of Finance to curb this yen freefall. And in dollar yen, you can see the chart, we're still hovering around the highs, near the highs, the 145 potential line in the sand, where the Ministry of Finance again potentially verbally intervenes and then potentially physically intervenes in the currency, but that is sort of seen as a line of the sand, even though this looks like, on a technical level, looks like just bullish consolidation before we then break through that level. The top side potential is for well, bulls hoping for 147.67. You can see there, that's the high from August 1998. Okay, I think we've covered a lot in today's webinar. Every 2 weeks obviously means we have a lot to catch up on. Obviously, we have all these central banks coming up in the next 48 hours, which will drive the dollar, drive bond yields especially, which have been on fire recently, and then potentially pro-cyclical currencies as well, that being sterling, also being the Aussie dollar and the Kiwi dollar. Obviously, the Kiwi dollar especially made new cycle lows. Dollar CAD, that made new cycle highs as well, above 133. A lot to keep us glued to our screens. Good luck trading out there, and we hope to speak to you in a couple of weeks' time.